All right. So today's guest, I'm so grateful to have him on the show. I'm very lucky because he's just here to support me. Didn't have to do it. Peter Mahrle, Wholesale West Lending. He's really knowledgeable, always available, just all around amazing human being, great family guy. And he's a hell of an athlete. I know he played golf in high school, but we have played men's slow pitch softball together. He's really good. But let's just put it that way. Me, not so much. I was an athlete, but for some reason, the floating giant ball, I just can't seem to hit it. So anyway, Peter, thank you so much for coming on the show. More stuff in the weeds here. It's like an analogy. It's like we're sports where you come to a point where it's not, it's not for sure thing. You're kind of starting to figure out that you might see a future and go in a different direction. And you're either going to have to outwork everybody at something, or you're just going to have to move to something where you're more naturally talented and you're actually playing into your strength as a person. And I bring that up as far as you're in a very big, important field of the mortgage industry. And so I don't know if that's something where there's something that people that are better able to work in that kind of industry, that's something that they want to pivot to in their career, or like straight from high school, or if it's something that you think that anybody can build and learn and kind of get into.
Sure. A lot of good questions there. And I would say a terrible answer is yes and no. I think the mortgages are, it's sales at the end of the day, and you're selling a mortgage product. And so if you're gifted in sales, then you can learn mortgages. And I think there are people who get into this industry. It's a very saturated industry. There is no secret that you can make very good money. People do make very good money in my industry. And some people make not a lot of money in this industry because they go in with the expectation that they can just catch a heat wave here, like we did the last couple of years, get in, I'm going to make some money, and then I'm just going to ride this thing. And then they realize, oh, I got to put in work. I got to build relationships. I got to build knowledge. And I think it also kind of depends on what part of the industry they go into. You have the broker side that I've been a part of for, going on 14 years now. And I've always, I know it's been a while. I know. And so like on the broker side of things, we're much more independent. And this isn't my term, but some other guys in my industry kind of call us the Navy SEALs of mortgages, where we have to have a lot of knowledge. We have to know a lot of different products. Whereas some guys in the retail sector, say at a bank, or they would just work for one bank or institutional lender, and they kind of have a lesser role in that they take the loan app, they see the client at the desk, and then they kind of bundle it up and then throw it over the fence and say, you know what, we'll be in touch. Where with mortgage brokers and professionals like myself, we have to be there every step of the way. We have to know the products. We have to build a relationship with the realtors. We have to know our stuff, and we got to be able to guide that client from getting pre-approved all the way to closing. And we got to be able to ask any question that's thrown at us, because if we don't, we look incompetent. We're not doing our job. And then people lose confidence in us. And you never want to lose confidence in the person that you're working with on probably the largest transaction of your life. So, but it's vitally important that we know, and for anyone who wants to get into this industry, to know that, but there's a reason why there's education requirements. There's a reason why brokers need to have a DRE salesperson license in addition to an NMLS license for mortgages. And but if you want to get into it, totally encourage anyone to do so. There's a lot of fun. There's a lot of flexibility. There can be a lot of money, but with that, it's pretty dog eat dog out here. It's pretty cutthroat. It's very cutthroat. Yep.
Pretty cutthroat. That's a good point. Not everybody can do it. My wife literally knows she can call Peter at any time in any situation. Doesn't have to be during a transaction, can be after, doesn't matter. She knows that she can call him and get answers and put her mind at ease, which it actually makes my life a lot better too. And we just know that we got Peter on our side. We've got a guy, and that's what separates Peter from the pack, from everybody else. He's just amazing.
Yeah, no, absolutely. I appreciate that. And just, they say in sports, the best ability is availability. And it holds true for mortgages too. When you're going through a transaction with someone, typically 30, 40, 60 days, whatever it is, as you're spending time with them, going through that home search, to be real close to them And then when taxes roll around and property taxes are due, they're getting sent a tax bill. They're like, hey, am I paying this? Is my lender paying this? That's a part of the package. So you got to be there to answer the phone. And you got to know those post-closing questions too. The last thing you want to say is, I don't know. I'll talk to your servicer. And you want to do that. If you don't know, tell them, hey, I don't know, but I want to find out. And make the phone calls because they come to you for a reason. And you need to be the one that is able to guide them, even if it's a post-closing question, even if you're not even a part of it anymore. I've had clients out of state. They're like, hey, I can't do Tennessee or I can't do Arizona. And they're like, hey, Peter, I'm going through a transaction over here. I know like you're not a part of this and I'm really sorry. And I'm like, don't be. Like, what do you got for me? I'm here to help you. And because I know that even though I'm not making any money on that transaction, they're coming to me for help. And so I need to be available to help them with that. And then when they know someone in California that needs a mortgage, they're like, hey, there's one guy that I call and it's Peter. Here's his number.
So are there any common mistakes that you see with people getting a mortgage for the first time? So maybe they're younger, maybe they're on that home buying journey for the first time, maybe some financial mistakes when they're going through the process, anything?
Totally. Great question. And I work with a lot of first time home buyers and I probably would work with more if I wasn't so honest with them. There's a lot of people that I tell, now's not the time to buy. You're not ready. And I think your listeners and readers will appreciate this level of honesty. Not everyone is ready to buy real estate. It doesn't make me any money to tell you you're not ready, but also it's my duty to tell you that you're not ready or you are ready. Some of the biggest mistakes that people make is they blow off their credit. And that's a big one. I'm a big Dave Ramsey fan, and I love a lot of the things that he says. And I'm all about pay down your debt. And he's also, hey, your credit doesn't matter. Well, when you want a mortgage, your credit matters. And so he and I disagree with us on that. He makes way more money than I do, and he's got millions of listeners. Right. Your credit matters, and that's one of the big pieces of getting a mortgage. And so, hey, blowing off that Comcast bill that you got when you quit service that is taking your credit down into the 600s because you just didn't want to take care of it and went to collections over $25 and darn it, I'm not going to give Comcast any more money. Well, it just cost you tens of thousands of dollars over the life of your loan because you didn't take care of that. I see that all the time. It's like that thing when talking back in high school, when your parents tell you, hey, good grades never close any doors. I say the same thing about credit. Good credit never closes any doors. No one's ever going to tell you, whoa, your credit score is too good. We're going to have to give you a worse rate because 815 is just too good. No, never going to say that.
Yeah, I know, right? Can't help you here. Get out of here.
100%. So take care of your credit. And also another thing that I see when people are getting ready to buy is a lot of changes in jobs. Instability in job history is also something you want to think that when you're getting a loan, you're wanting to present the lowest risk you can to the bank because that is everything. Like your risk factors will determine your interest rate and will determine whether or not you get a loan. So the riskier of a borrower that you are, the higher the rate is going to be, and it's going to cost you more money over the long run. So a big thing that you want to do is lower your risk. So have good work history, good credit, save up some money. I know it's tough these days, especially in California. Life is expensive, and I sympathize with people about that. Don't worry about the lifestyle. Don't let that lifestyle creep happen. That's a big thing. I see massive credit card debt. I see people buying stuff.
Keeping up with the Joneses type of thing.
Mom's got to have that nice SUV with the TVs. And then all of a sudden, debt to income ratios get all out of whack. And it just, hey, live simple, save money. That's real big. So have a good work history. Most of the time, depending on the loan program, banks want to see a good 2 years of work history. And it doesn't have to be in the same job, but they like to see it consistent. So the longer the work history, increasing income, that's another big thing, is you don't want to go from making 80,000 down to 60,000. Then you're going down to say 40,000 the next year. If you show me that, we're going to have to come up with a good explanation as to why you have a decreasing income. Because an underwriter is going to want to project what the next 3 years are going to look like for you. And so they've got to be able to sign off on your income after they write this mortgage. So they want to make sure that you're going to continue to be employed. And there's a lot of contract, a lot of gig work out there. We're coming across a lot of those where people got their side hustles and they want to use that for qualifying, which I think is great. But if you're going to have 2 jobs at the same time, you have to have a 2-year history of having those 2 jobs in order to use it for qualifying income. There's some exceptions in a lot of the stuff. The information I'm going to share is the general rules when it comes to underwriting, and it'll apply to most loans and most scenarios. Yeah. So get your income history, and then also have a budget. I come across a lot of people who don't have a housing budget in mind. We don't know what we can afford. Well, you're going to have to figure out real fast. And sometimes it just takes running numbers with me and just people saying, hey, we think we can do this. We pay this in rent, so we think we can do this with our mortgage. And I caution them because once you compare a mortgage to a rent payment, just because you can afford your rent payment, don't forget, you're now the landlord when you own that home. So when that garbage disposal conks out, call that landlord. Oh, there's no one on the other line. That's you. That is you. So it's either university or you're paying a lot of money to someone to come out and fix stuff for you. So that's a big thing that I educate people too on is renting versus owning is very different. And so a lot of people don't think about that before they start getting into a mortgage. And so I just try and explain it to them. And so just being prepared. Have your documentation in order. Those are the big things though. Have your income set, be in a stable job, because the last thing you want to do is be in the middle of an escrow. Have us double check to make sure that you're still employed when it comes to close, and then have the boss say, he no longer works here anymore. And then all of a sudden I call you and say, you no longer have a mortgage. Gonzo, like, you have a job. We can't close this down. So yes, that's big.
Right.
That's
right.
big. Yep.
Man, how was it with the pandemic? There were a lot of people that were able to back out due to anything COVID related. Did you see a lot of that?
I'll be honest, man. During COVID, the mortgage industry was so busy. Rates were so low. It was the busiest time that we've ever seen, which is very fortunate because now it's incredibly slow. So there is payment relief. There was a lot of good options for people with COVID, which there should have been, especially when the government is mandating shutdowns and businesses closing doors. If you're going to do that sort of stuff, you need to give the people a means to either put off their mortgage or pay it when they can or whatever. So there's a lot of good programs out there. We didn't really deal with that on the originating side very much. That was more on the servicing side of things. But we did deal with a lot of clients who were getting out of forbearance and needing to get that wrapped up before they were able to move on with the new transaction. But yeah, but COVID definitely had a positive effect on industry, which was inverse of a lot of other industries across the sector. So we were just very fortunate that we had a good run there with the low interest rates.
Before we move on from California, can you tell me a little bit about the California Dream for All program?
The Dream for a Few?
Yeah, you should totally. I saw that didn't last. And then like you said, though, as a whole, the communities in California are just so expensive. Some of the jobs aren't great. Some people have low paying jobs. They're locked in. Some people have rent payments, credit card bills and stuff. And there's some of these things that California has supposedly passed to help homeowners. And I'm really hoping that they are going to help homeowners, kind of like the California Dream for All, but I don't really know what's going on during that time or if it has actually been beneficial to people of California or not. Can you maybe talk about it?
Sure. Yeah. It was a well-intentioned program and it was put on by CalHFA, California Housing Finance Authority. And they had $300 million set aside to give to borrowers who, for a 20% down payment. We had heard rumors about this. This had been a long time coming. This was not a surprise to the mortgage industry, but we didn't know how much money they were going to offer. We didn't know what the rates were going to be. And it caught the California housing market at a very low supply point. So the CalHFA program infused a bunch of buyers into an already tight supply market, which had kind of an adverse effect. And they only had 300 million earmarked for this. They didn't have a limit on how much you could get. The only thing that they had really limits on was the income. And the CalHFA income limit just for Sacramento County, $202,000 for the qualifying income, which is significant for Sacramento County. And so really most people who wanted to take advantage of this program were able to, as long as they had the right FICO score and their DTIs and everything checked out and followed CalHAFA's guidelines. That came out on March 27th. And then we got the notice on April 10th that all funds have been reserved. And the guys in our office, we weren't surprised by this. We saw it coming. We had clients who were pre-approved based on this program. And we said, hey, this program is only good until the money runs out. There's only 300 million. And we kind of did the math. And we were thinking, well, if there's an average of 100,000 utilized on this program per borrower, that's only 3,000 transactions for the entire state. And this was at a time when, Sacramento County had like just over 900 pending transactions when this program came out. So that's just in Sacramento, the county, the region of Sacramento County had 927 transactions. So if you put that into context with we're guessing about 3,000 families were going to be able to utilize this program. That's hardly anything. So when it came out that it was dried up, not surprised. We gave all of our people a heads up. Hey, there's no money left. And so if this program gets funded again, or if CalHAFA comes out with something else, then we'll give you a heads up. CalHAFA is still running a lot of their traditional down payment assistance programs that have been popular for years, 3.5% down. And then they have seconds and thirds behind that people are able to utilize. Now, with those first time down payment assistance programs that we do, they do carry higher interest rates typically. They do have income limitations and they do have minimum FICO requirements. But it can be a good option for someone who is in a situation where they've got good income, they just can't save much. And so we've been able to help a lot of borrowers get into homes and get into a situation that's good for their family, just based on their income, and they're able to make the payments. And a lot of those mortgages actually have been performing. So CalHAFA has been seeing some good success from these programs.
I know some of this goes away from just mortgages itself, but like when there's not a lot of supply, what does that mean for people like with housing prices and stuff like that? What does it mean for issuing mortgages? What does it mean maybe for people not having enough budget actually to buy houses that they think they can buy when we have these quick rises? Because I know backpedal to when you're talking about not just California Dream for All, but when the interest rates were low, that created a very high amount of demand. And it wasn't just all first-time home buyers. There was a lot of investors, which we know that they have a lot of money and that they're willing to push around their weight quite a bit when it comes to housing markets. And then maybe again, what homeowners that are, especially first-time home buyers, how they maybe can afford a home, like what they should be looking for when there's a high demand, like bidding wars and that kind of thing.
Yeah, like you said, when interest rates were low, it really stoked demand, mostly because affordability was high. When you have low interest rates, the payments are lower. And so people are able to afford more home. And also we had a supply crunch there as well, because a lot of Californians who were selling their homes, they were either looking to move up or a lot were moving out of state, as we all know. And they're kind of cashing in, and for whatever reason, they did not want to stay in California. And so they're creating some supply there with leaving the state. And also supply and demand governs the market. I'm a true believer in economics, and it is the guiding hand. So we had a lot of demand, and then there was not a lot of supply. And so when you had low interest rates, you had buyers who were able to afford more than what they typically would be able to. And so they were able to get into the market and homes, but also the supply wasn't that high. So when you have more demand and you have supply, prices are going to go up, which is what we saw. We saw a huge run on the market winter really of last year, when the Fed started announcing that they were going to raise the Fed funds rate, which stoked a lot of fears that the interest rates were going to go up. And we can get on to that topic later, but to stay on the supply and the demand thing, people started panicking and saying, "Whoa, we got to get in while the rates are low." And they were right. They needed to. And so they started just going bonkers. And so it really stoked demand. Prices shot up. And then as the Fed raised rates, and then we saw an increase in mortgage rates as a result of that, as an indirect effect of the Fed raising the rates, we saw demand cool because all of a sudden people weren't shopping at 3% anymore. They were getting pre-approved at 4, then 5, then 6. And all of a sudden their monthly payments were jumping up and they're like, hey, we can afford this. So we saw a very rapid cooling in the market. And as a result of the rates going up as fast as they did, we knew that they were going to go up. We didn't know how fast. No one was anticipating how fast the rates went up. I remember winter of 2021, and they were saying, hey, party's going to be over soon, guys. And we were like, yeah, we know it's going to be over. And they said, maybe by the end of 2022, we're going to see rates in the low 5s. And if anyone's telling you where rates are going to be, no one's got a crystal ball. Everyone's crystal ball is just as hazy as everybody else's. It's all cracked. No one knows. But then the rates ended up hitting the 5s in early May about? Mm-hmm. So much faster than what was forecasted. So we saw a wildfire in demand, and then we saw a rapid cooling, and then prices started to drop there in July and August as sellers started to realize, hey, this hot market isn't hot anymore. And so people were putting their houses on the market saying, if people are going to pay crazy prices, I'll sell. Sure. And then the market's cooled off, and then they kind of got stuck. They're like, oh, well, I can't sell my house for this anymore. You know what? I thought I was going to get 20 offers on this, and Huddy, you can attest, it's been sitting for 3 weeks, 4 weeks, and now people are panicking, thinking, what's wrong with my house? Nothing. Just people can't afford it anymore.
Just had to bring them back down to reality. I mean, you're not, those prices were a thing of the past, and you're not going to see those for a very long time. So let's just put those behind us and move on. You know what I mean? Because people automatically just, well, my neighbor got their house for this much, for this amount, and for this rate, and why can't I? And it's like, because that was then and this is now, and people don't quite understand that.
100%.
That gives me a good segue for a question. What is going to happen to all those loans that are sub 3%? Are people ever going to sell? What's going to happen to those properties? Why would anybody ever want to sell? Especially as an investor, that's a little bit of a way for first-time home buyers, but even first-time buyers, are they going to move up? Are they going to be a move-up buyer at 6% interest rates?
I think we're kind of seeing the answer to that, and the answer is no. We're seeing, there's that meme going around on Instagram where it's like, oh, people with rates in the 2s, and then was a Wolf of Wall Street. He's like, I'm never leaving. It's like, I'm never leaving. And that's the way I am right now. Like my wife and I, we bought our house, and we have a rate that's pretty dang good. And we look at ourselves and we're like, are we ever going to move? And I'm like, not at this rate. And I'm like, nope. And
no. Yep.
And so you're like, well, looks like we're going to add on.
That's the exact same conversation me and my wife had.
And actually, funny thing is, if you don't mind me talking about this, that's what we saw with construction during COVID. Saw a lot of people staying home, and then we saw a lot of people doing at-home projects, and then rates went up, which means people weren't moving. People weren't touching those low rates, so they took out a bunch of HELOCs. So they took out a home equity line of credit, which is what HELOC stands for, and they were like, well, we got a really low rate on our first. Let's take out some money. Let's make our house nice, because if we move, our payment is going to double. So we're not going to move. And so obviously that drove material costs sky high and whatnot, but a little tangent there. Tons of fun. I know I did it. Yeah, for sure. But no, I think you're going to see a lot of people staying and being content with the houses. Unless people start, keep having kids and need the space, then yeah, right. We're going to find people being content, making their houses work for them. And will we ever see rates in the 2s again? I don't know. I just harped on everyone else making rate predictions. Like I'm not going to. Could we? Sure, we could. It's possible.
Yeah.
Rates in the 3s, maybe. They say rates will fall following a recession, which a lot of people in the market right now are saying that we're well on our way to a nasty recession. And historically, rates will follow and go down after a recession. But we don't know. No one's got a crystal ball. But as far as trying to get people to budge out of their homes right now, out of their 2.75% interest rate, I don't know. But I'd like to talk about a product for some of your listeners that can benefit them If they're obviously doesn't help me because I don't make any money off this. And most mortgage brokers and mortgage professionals won't tell you about this program because they want you to refinance, but it's called a recast. And a lot of servicers offer these. A lot of the lenders that we work with do. And what it usually is that you have a minimum payment made on your principal only. And then what they'll do is that they will re-amortize your loan to the maturity date. Again, so say you've got a $300,000 balance on your current mortgage and say you're chilling at a 3% interest rate. And you're like, man, this is great. Would love to get my payment lower though. Don't want to refi because rates are higher. So what can we do? You can do what's called a recast. And you call up your servicer and say, hey, I got a chunk of money. Maybe you get an inheritance, maybe get a bonus, maybe you've saved up a bunch. Maybe your kid went off to college, got a scholarship, and then you didn't need to use that college money anymore for school. And you say, hey, I'm going to pay down a chunk on my mortgage. And you call the servicer, and usually there's a nominal fee, sometimes between $300 and $500. And you say, hey, I want to make a principal only payment, send you what the recast is going to look like, and go for it. I did that for myself personally. I did that.
Oh yeah.
And we put down a chunk of money on our personal mortgage. And so it cut our payment in half. And so we're still enjoying the low interest rate and a lower payment since we were able to do that. And we didn't have to finance.
How long ago? You mind me asking?
We did the recast like 2 years ago. Yeah.
Cool. Yeah. So you've been enjoying the benefits for a few years.
Yeah. My accountant's not too happy that my mortgage interest is a lot lower than it was in the past. Yeah.
Yeah, I'm sure. What am I supposed to do with this?
I'm like, I know. But but it's a great product. So definitely for everyone listening and reading about this, definitely check that out. It's a beautiful option for people. It's a lot cheaper than a refinance. And especially if you're in a low interest rate right now, it's a great way to save on your monthly expenses as well. It's with your particular servicer who you're paying your mortgage to. So give them a call. Say, hey, I want to find out about a recast. They'll usually have a minimum principal payment. A lot of them out here, it's about $10,000. So if you got $10,000 or more saved up, and you want to put that money towards your mortgage and benefit from a lower payment, ask them about a recast. It's a great product, and the banks don't make a lot of money on it, which is why they're not going to advertise it very much, which is why you got to ask about it. So go ahead and check that out. It's great.
That's perfect. Kind of wanted to ask, well, can you kind of explain what the system of why federal rates move around and stuff like that, and then how they affects the mortgage industry and how it affects people's purchasing power and whatnot?
Sure. I'll try and explain it the best I can. And it's a pretty confusing topic, really, which is why we get a lot of calls on it. And a funny story about when the feds put the rate down to 0, you wouldn't believe how many phone calls I got. Hey, Matt, can I get some of this 0% interest rate? Like, what do I got to do to get that? And I'm like, man, I love you, but if rates were at 0% right now, you would not be able to get a hold of me. Like things would be going nuts.
That's a good point.
So the Fed rate does not directly impact mortgage rates. It indirectly impacts them. I don't want people to think that, the Fed rate doesn't affect mortgage rates. It certainly does, because it affects the entire market. So when the Fed is raising the Fed overnight rate, it's basically at the rate that banks are borrowing money overnight because they have a reserve requirement that they need to meet. And so sometimes they need to borrow money from other institutions in order to meet that minimum reserve requirement. So as the Fed is raising rates, they'll use it as a monetary policy to either help or cool off the economy. And right now, obviously, with inflation being as high as it is, that inflation is the big thing that's driving interest rates and the Fed raising rates to try and cool the inflation. Everyone's feeling it. Have you bought eggs recently? It is everywhere. And so basically when the Feds are announcing that they're raising the Fed rate to cool the economy and help combat inflation, it's going to have a trickle effect in the entire economy across all sectors. And it affects the bond markets, which is what mortgage-backed securities are and the mortgage rates are based on. So when it affects the bond market, interest rates will react. And so when the Fed raises rates, it affects the bond market, and typically interest rates will go up and they will move with the Fed and where they move their rate. So when you hear about them, well, the Fed's raising rates 25 basis points. Well, that doesn't mean it's a 25 basis point impact on mortgage rates. Sometimes it's more. Yeah. I like to tell people, like, surprises are either a good or a bad thing for interest rates. Because if the market is expecting, we've been expecting these interest rate hikes from the Fed. And so they already start building these interest rate hikes into the rate sheets that we get. Pretty much the month before, we've already started a steady climb up to where they think that the rates are going to end up. So we don't really see any big swings with a Fed rate decision unless it's unexpected. So say we're expecting a 50 bip rate hike, which the banks have already built into their rate sheets and they've already factored all that in. But then if the Fed surprises us and says, we're doing 25 bips or we're not doing one at all, then we can see a massive swing in the interest rates, because that'll send a real shock to the economy and say, whoa, like, we weren't expecting this monetary policy move. And so it could have quite an effect. And adversely, if we think that there's about going to be a 25 bip increase or a no increase, and they come back and say, oh, we're actually going to do 50, and they didn't price it in and they didn't factor this into their rates over the last, in the buildup, we can see quite a knee-jerk reaction in the bond market and the interest rates as well. And they can react. So, big time. Surprises are things that keep our days very interesting. So, yeah.
Yes, that's a good way to put it.
We like to keep it boring, or surprises in a good way. Oh, yeah. We don't like bad surprises when all of a sudden the ticker goes red and we're like, oh no, hey, call everybody up. We should lock. And then, or here, the ticker's going green. All right, good. Float. Let's get our borrowers some better rates. So
that's basically the conversation you're having in your office with your colleagues and stuff.
Last couple of days have been kind of rough in the markets, but we try and keep our clients abreast of any sort of moves in the market. We have economic calendars that we monitor, and we look at the 10-year treasury, 30-year mortgage-backed securities. We keep track of the charts on the daily. Everything's up on our screens. And so we monitor things pretty closely.
Well, it'd be fair to say, just for what I guess probably more than 90% of Americans and anybody that's international too, that has a similar government style to us, like the Federal Reserve, is really high level, almost dealing from business to business almost, right? And then below that is where we're seeing the service providers that are reacting to that high level monetary regulation. And that's why the rates are changing.
Yeah. For the most part, where a lot of people are reactionary to whatever the Fed's doing. And so everyone's going to kind of want to see what moves the Fed's making. They want to know. But the crazy thing is right now the Fed is the mover in the market. Everyone bonds, stocks, everyone's paying attention to inflation right now. But that's not the only thing that influences interest rates. That's not the only thing that can move stocks or the bond market. What was it last year when that big major Chinese developer was threatening BK and they were going to default on their debts? And they thought that could send a major shockwave through China, which caused a lot of instability in the markets, and interest rates reacted really well to that. Without being absolute, I like to say interest rates love chaos. If there's chaos going on in the world, instability where people move money out of stocks into bonds. And because bonds are a stable investment. And so if they're moving money into the bond market, then typically we're going to see improvements in rates, in supply and demand. People are moving money into bonds, then they don't need to give them as much of an interest rate because there's a higher demand on them. And so people will be moving money out of stocks into bonds, and we can see some improvement. Like when this tragedy in Ukraine, with Russia invading Ukraine, causing instability with major gas pipelines in Western Europe. It's just the tragedy that's going on over there. We closely monitor from the mortgage side, stuff like that. Gas prices, things that affect Americans on the daily, can have an effect on movement in interest rates.
And so I've noticed, like, most people, like, for the majority of people my age, around my age, I'm an older millennial, and they're just like, what is a bond? Is that what old people bought back in the day?
Some of that grandma stuff's in your stocking every Christmas.
Is it safe to say that bonds are something backed by typically, like in our case, the U.S. government, which is also like the U.S. military and the world reserve currency? It's something that when money moves into these markets, when you're watching the news, people are watching, they see the ticker symbols and the stuff, and money's moving in there. You were basically elaborating that we can sometimes see these rates take a cool off because there's that change of money from most likely hedge funds and stuff like that, or kind of moving their money to rebalance their portfolios. Is that kind of how that works?
Yeah, basically mortgages are more closely tied to the 10-year treasury. And also there's 30-year mortgage-backed securities, which are basically pools of mortgages that investors invest in. And then we also carefully monitor that. That has a more direct effect on interest rates when those are moving up or downwards. So yeah, a lot of things that the normal average Joe buying a mortgage, getting a mortgage doesn't really pay attention to, doesn't need to. But it's something to be mindful of when you're seeing chaos in the markets. Hey, what's going on? Or just Google, what are interest rates today? And you're going to find like 50 different websites trying to tell you what are interest rates today. And people can get educated. And that's the beautiful thing about the internet is that we have the most educated buyer ever right now purchasing homes and getting mortgages or coming up. Time.
That helps.
Big time. Because we're talking about one of the things that people do, or I'm sorry, what they don't do correctly when they're getting a mortgage is shop it.
They don't even realize that they're allowed to.
Right. They're just like, oh man, my guy told me I got to use this guy. And
yeah, basically you start with one, you end with one. That's what they're thinking.
And then they find me and they're like, hey, what are interest rates? I heard they're this. I'm like, nope, I'm way lower than that.
Nope.
And as a broker, you are. And so yeah, that's one big thing. People are able to go online. They're able to shop. They're able to see, okay, what are interest rates supposed to be? Where do I think I'm at? And they can kind of shop things around and be educated and be a savvy buyer. And I'll tell you, you shop your mortgage, you're going to get a better rate and find someone that you trust, like a mortgage broker like me. And local is usually much better. Someone local who has a relationship with your realtor, who has knowledge of the local markets, who know local appraisers and people in the transaction, usually will give you a better result. If you can come knock on my door and come to my desk and say, I need some explanation on this paperwork, that's usually going to be a better transaction than talking to some headset jockey in the middle of Kansas who's making $10 an hour, just trying to wheel and deal mortgages. He doesn't know what's going on. I can tell you, I've got a lot of people who have come from online companies saying, I don't know, I can't get a hold of my guy. He's in Nova Scotia somewhere or whatever. And I'm like, I'm right here. And well, it's the weekend. I'm like, I'll be over in 30 minutes. Yeah. It's huge.
Totally. Yeah. So, let's just say, can you say that like maybe I'm shopping around for my first home, or maybe it's not even my first home. It's just a big purchase. And am I able to email you other information that I've shopped around, I found, and, say that, is this the rate that I got that you told me this is going to be? And these are the points and stuff. Is that what you mean by shop around?
Sure. Absolutely. I love getting quotes from people who like what's called a loan estimate. So when you talk to a mortgage professional, you want to say, I want a loan estimate. And it's a standardized form across the industry that will explain to you the mortgage terms, points, fees, and everything. And what that does when you're able to give someone else a loan estimate, it's kind of cheating a little bit because now I kind of see the other guy's hand. But the other thing that's good about it though, is that I can make sure that I'm giving you an apples to apples quote. Because what will happen is someone will talk to, say, an online person or another lender, and they're getting a quote for an FHA loan, which is a government-backed loan, which has a lower interest rate and comes with higher mortgage insurance. And maybe I think that a conventional loan is a better fit for them, and they can save money doing that, but the interest rate might be a little bit higher. And then all they do is they just see the rate. They don't pay attention to anything else. And then all of a sudden they wonder, well, your rate's higher. Well, no, we're just comparing apples and oranges. So that's why I like to get a quote in front of me and say, okay. And also some lenders will put lower taxes or insurance or whatever they'll sandbag those costs and those estimates because they don't know what the actual estimate's going to be until you're in contract. And so what they'll do is that they'll really lowball those to make their estimate look good. And then you'll pull to get something different when they knew all along that it was going to be a lot higher than what they provided you. And you get hoodwinked and you're in the middle of a transaction. You're like, well, I don't know. And then you call up Huddy and you're like, dude, I want to change lenders in the middle of the transaction. And he's, well, I told you to use Peter in the first place. And like, we're kind of telling too late. Like, can you do it? Yes, I can. And you don't want to be at that point. So that's why an apples to apples quote from people that you trust, 2 to 3 quotes will really give you a good ballpark as far as whether you're getting a good deal or not. And we'll give you a good baseline for what kind of mortgage you're going to be able to get.
How does it affect like how long you have to shop around, and how does it affect like how you're going to get, are you going to have a hard pull on your credit every time and you're shopping around to find a lender? Is it really considered a hard pull because they know they're just shopping around for a mortgage? So you're only getting hit so much instead of, hard pull?
Sure. So some will do a soft pull. Not many will. Mortgage companies like to do a hard pull just because it gives you more accurate score. And the algorithms used on a mortgage pull are different than like credit card or a car loan, which a lot of people don't know. So if you're relying on Credit Karma, please don't use that as a general guide. But when we do a mortgage pull, it's a different set of algorithms that we get our scores based on. So if you come at me and say, hey, my Credit Karma score is 760, your mortgage is probably, the FICO score that I'm going to pull is probably a 730 or a 740. It's usually a 20 to 30 point difference, sometimes more. And so, but if you get a few pulls within 30 days, the credit bureaus know that you're shopping for credit. And so it won't hurt you that much. And by that time, you've already had your score pulled. So if your score drops 10 to 15 points over the course of 3 pulls, as long as you do them pretty closely together, everyone's probably going to pull the same score.
So let's just say someone came to you and they've already had 4 mortgage estimates. Do you have to take that into consideration that they're shopping around that many times?
I'm going to pull what I'm going to pull.
And that's really,
I can't use someone else's credit score, credit report that they pull from a different lender. At that point, if they're like 4 or 5 lenders deep, that's usually a red flag. I'm looking at that person. I'm like, okay, so either they're not getting the answer that they want to hear. That's a big thing. They keep going until they find someone that's going to tell them what they want to hear, not what they need to hear, which can be very dangerous in a mortgage transaction. And at that point, I'll probably just say, well, give me your credit score. I'll just give you an estimate based on that. And you can line me up to the 10 other quotes that you got. And just know that I'm going to give you the best service no matter what. And just compare me and see where I land. And just give me a fair shot at it at that point. So, if I see 4 or 5 estimates, then usually there's something going on there.
Yeah. They're like super high maintenance.
I mean, could be. There's been some where like I'll get off the phone with them and be like, well, now I know why 4 people have stopped taking their calls. I'll be honest. Sometimes that happens and you're like, but I'm that guy that I'm a glutton for punishment. Sometimes I'm like, call me back. Take you. That's fine. Yeah, we're right. Everyone else is ignoring you. Come on. I'll take you. Yeah, Peter will do it.
Peter, yeah, for sure. Peter will do it. That's why you've been around for so long.
Yeah.
I have a few more questions that are pretty common, but can you tell me some things about PMI when buying a house? Should I be considering buying a house? Like I don't have enough money for down payment, so I'm going to have to pay for all this PMI mortgage insurance. Should that be a concern of mine trying to get into a house?
No. One of the biggest myths when buying a home is that I need 20% to put down, a minimum of 20%. And if I'm talking to an investor, that's our conversation. You're going to want 20 to 25% down on an investment property. But if it's your primary residence, then I'd say, look, like, what do you have? Not everyone can save up 120,000 down to put down on a house. Even Dave Ramsey backpedaled a little bit because he always used to be 20% down. And now he says 10%, and which I'm really happy that he did. And because 10% is a solid down payment, even 5% is a solid down payment these days, especially in California. Holy smokes. Yeah. And again, like when you're talking about mortgage insurance, if you've got great credit, mortgage insurance is cheap right now because there's a lot of competition in the market. There's a lot of mortgage insurance companies out there. It's cheap. It's cheap. We got some lenders who've got proprietary pricing with some of these mortgage insurance companies. Super cheap. I got a client right now who's in contract who they were like, I don't know, we only have 10% down and we don't want to pay mortgage insurance. And they asked me like, what's our MI? I said, $35 a month.
That's better than some HOA fees.
Yeah. Don't go to Chipotle this month and you get your BMI covered. Of course, it's probably with the extra guac. It can be cheap. But again, if you got lousy credit, if you got bad credit, PMI is expensive. And recently FHA, which is a great program, they recently lowered their monthly MI factor from 0.85 to 0.55. So they shaved quite a bit off the monthly factor. So if you have a lower FICO score, FHA is again a great program for you to check out with 3.5% down. The lower monthly MI is making it more affordable for people right now. So definitely check that out.
For the part of the community that is interested in single family real estate investing and stuff, have you ever dealt with people trying to go FHA and into a duplex or a fourplex so they can out one side? And is there like any weird income things that people need to do, or do they need conventional loans? And anything that's kind of related to, I think people are calling it house hacking now. It's like what a lot of younger real estate investors are calling it these days, where they can like basically almost live for free and then they can move at some point, which there's some time requirements that people don't talk about, and then move to another place.
Sure. No, that's great. Great topic to bring up. Yeah. No, FHA, someone buying a duplex or a fourplex, a triplex, multifamily housing, you do have to live in one of the units, and it is a popular hack, and you can use future rents towards qualifying, which is way cool. That used to be a real popular hack in California. Not so much anymore, just because of where prices are right now for duplexes and triplexes and fourplexes. They are crazy because people know. So they're very expensive, and you're competing with investors. There's still a lot of investors out there in California scooping up properties. And so a lot of the investors that I work with kind of do it in an unconventional way. A lot of them, single professionals who different house hack that you could talk about would be converting primary residences into rentals. And so I've got several clients who they'll buy a house as a primary residence, put less down, live in it for a year or two, and then convert it into a rental and buy another primary residence, and then acquire properties that way, get them rented out, which was a lot easier to do with lower interest rates. Again, I'm not unaware of that. When the interest rate market was a lot better for this, there were a lot of people who kind of hacked their way into owning 2, 3, 4 properties. By that time, they pretty well get leveraged out at that point, which is too risky for my personal investing. With a family, it's pretty hard to tell your wife, hey, babe, we're going to move every 2 years and to a new residence. That's your situation. Man, more power to you.
Totally. If you can do it and
100%.
fix it up while you're living there, if you have the skills.
It's a great house hack and a great way to get into investment property without putting down big money. So that's a really good way. But yeah, the FHA multifamily purchase, if you can make the numbers work, if you can get the rents to work and to cover your payment, then go for it. It's a great way to get into multifamily housing for an investor.
I love that you brought that up, because I definitely, as I've gotten older, I'm trying to get into more passive towards any type of finances or investing. We have families. Me and Alexa are trying for number 2 right now. So your time gets pulled away, not for a bad reason, but for good reasons, because you want to spend time with your family and be a part of those moments. So moving to a single family home and then making that move, maybe even only once or twice, can be life changing. And because real estate is such a big asset to have, can you explain if you can have unlimited residential mortgages, and what happens if you have a lot of debt? Like, what could happen when I'm trying to get mortgages if I owe $500,000, $600,000, $700,000 on these houses I keep stacking? And do their rents help me on my past properties too when I'm trying to buy my next property?
Sure, absolutely. So for investors who keep accumulating properties, there does come a point where you have too many finance properties and you'll no longer be able to get a loan. Last time I checked, I believe it was 10. They cap you at 10. And for good reason, they don't want you to be over leveraged. And There's a lot of people who did that 2007, 2008, and we kind of know what happened there. And a lot of people were very house rich, and then they became very house poor because they were over leveraged. Right now, we're not seeing as many just because of where the rates are at. It's harder for properties to cash flow for investors that don't have a significant amount of money to put down. But yeah, when I take a look at a file and I take a look at an investor who wants to purchase, we take a look at the rents. A lot of people like to report losses. They team up with their CPA and they're like, hey, this is a tax shelter for me. And their W-2 income, and they're like, hey, I need to have some sort of tax shelter with this investment property and get some losses here for a tax benefit, which is great. With everything on the up and up, great, do it, go for it, work with your CPA, all for that. But then we also have to take that when I look at a mortgage application and then I look at your taxes, I'm like, you're taking some fat losses on these rental properties. And now I can't use these rents. Like you've got negative rents or you got massive losses and you're just writing everything off. And then it negatively impacts your income and it can negatively impact getting a loan. When we take a look at stuff, the things that we don't mind seeing is depreciation because we can add that back in when doing your qualifying income. So we like seeing that depreciation item there. And rents and income is all good. And I applaud the courage and just the gusto that it takes to invest in real estate. It's not for everybody. And you need to have a type of personality for it. You got to be able to ride the highs and ride the lows and have a plan. That's a big thing. You just don't want to be a gunslinger, just investing in real estate. Have a plan, know what your cash flow is going to be, have reserves. A big thing that they look at is reserves. And there's going to be a reserve requirement when you're trying to acquire an investment property or you have investment properties and you're going to try and acquire a new primary residence. There is going to be a reserve requirement. And we can use retirement assets. We can use liquid funds. And then for all the crypto borrowers out there, we do have clients who have crypto. And if they want to use it for a transaction, it needs to be converted into US dollars, and that is allowed. But just don't think you're going to send me your Coinbase. Like, yo, I got all these assets. It's in this funny money. I'm just kidding. Not fine. But, it's all in crypto. I'm like, oh, that's great. Well, they can't take it. What do you mean they can't take it? It's crypto. I'm like, banking. Think of monopoly. The monopoly. Like, these guys are not on the cutting edge of with crypto and all this new currency stuff going on. They convert it to US dollars and we're good. So I hope that answered your question a bit and kind of gave everyone an explanation as far as if you're getting into the investing game, mind your tax returns, file your taxes. A big no-no for us is if you've got investment properties and you don't file a Schedule E and you don't declare your rents, then we cannot use any sort of rents for that in most circumstances, especially if the property's been in service for more than a year, then we won't be able to use just a lease agreement or anything if you haven't filed your taxes and claim that income. Yeah. So make sure you file your taxes, claim that income. So then we can use it. So then you can use those rents to qualify for another investment property down the road.
Would you suggest that if you're going to be investing in properties, just like the smartest move is just go talk to CPA? You don't need to actually hire one. At least go talk to one. If you're going to be making such a big investment and try to invest in so many things, it makes sense to kind of get a plan going with the CPA and then kind of maybe go from there.
Oh, 100%. Having a good team of a good financial advisor, a good investor, a good CPA. Sometimes if you're getting real into it, you might need a contract with a real estate attorney, figure out trusts, talk to an estate planner, figure out tax shelters that way. Again, I'm not a tax accountant. I don't give advice as far as legal advice goes, but have a good team of people you can work with so that you can take advantage of loopholes, opportunities to shelter your money from unnecessary taxes. And also talk with CPA about forming LLCs, S Corps, different ways of owning property that can give you some tax advantages that way. And also give you some liability protection as well when you're dealing with tenants and all the things that can go wrong with being a landlord, and especially in the state of California.
It's just a lot harder. Even our rental laws are hard. And there's still areas in California where tenants still aren't paying rent.
Oh, yeah.
They go back and forth on whether or not they're still under the emergency protections of having to pay rent. It takes a long time to evict people here, depending on the county.
Yeah. a lot of newer investors I'm not really seeing in California, so much more 1031 exchanges, a lot of 1031s happening, especially since we're so close to the Bay Area here in Sacramento. They're cashing in some of their investment properties in the Bay Area and then purchasing some less risky investments here in the Sacramento region. And so we're seeing some significant down payments through 1031 exchanges here with some of the more savvy investors. So just moving money around and picking up additional properties. And yeah, like cash flow is a very tough thing right now. If you're not putting down a significant amount of money with where interest rates are at, guys are buying down interest rates, points, just trying to figure out how to make something cash flow. And sometimes the numbers are there and sometimes they're not. And a lot of times an investor is probably not going to force a bad thing. And so they're just kind of sitting on the sidelines right now, kind of waiting for deals and exploring out of state, like you said, and just trying to see where they can make some money. And with some places that are a little bit more landlord friendly. And it's no secret that California can be a little rough on landlords, some of our tenant laws. And so, yeah, it's kind of spooking some investors. There's some that are welcoming the opportunity and they see nothing but growth here in Sacramento, which is encouraging, which is fun. It's a great scene to be a part of right now. A lot of things that we can poo-poo on with Sacramento, but definitely not the Kings, though. But yeah, we're experiencing a lot of growth and people are seeing why this city is as awesome as it is right now. And we see a lot of people moving in and a lot of Bay Area people saying, oh, we should have made this move a long time ago. We love Roseville. We love Sacramento. Folsom's great, like great schools, great communities, great people. I think it's one of the big things about Sacramento that's underrated is just how great the people here are.
That brings up a good point. There's always a bigger fish out there too when it comes to investors. The 1031 exchange, because sometimes you tell people that and they're like, I don't even know what that is. Maybe your opinion, because this is what investors have to deal with in the hot market. If they're coming with a 1031 and I'm just coming from my cash flow, they're a lot of times seeking a very safe, awesome investment. Sacramento is a great example of this, which will probably have a lot of appreciation. But someone coming with cash is probably looking for a more cash on cash return, right? Because if they're trying to get their cash back so they can buy something else later on down the road, maybe you can explain just a little bit about that as well as a little bit about 1031 exchange itself.
Sure. So 1031 exchange in a nutshell is a way for an investor to avoid capital gains tax on the sale of an investment property. So basically, you'll have a 1031 exchange company that will handle the money so you'll sell your investment property and those funds will go into an escrow account with the 1031 exchange company. And then that company will then charge you a fee to do this, of course. And then they will deliver the funds to the new escrow of your new investment property. So the funds never actually go through you and you never touch the money, which is how you avoid the capital gains. And so why sellers like them is because there's a finite time when an investor needs to identify a property and close on it in order to take advantage of the 1031 exchange. So they may like a 1031 exchange buyer because they know that they need that property. They've identified it. They need to close on that property because they want the benefit of the 1031 exchange. Where if they see you, a pool buyer, or someone that's not a 1031 exchange who may back out for whatever reason, the numbers might not work out, the inspections might not go according to plan, they may view you as a more risky buyer unless you're all cash, of course. But if they see a 1031 guy who knows that, hey, this guy needs this property, he needs to close, and he's motivated to close, they may take that over someone like you or someone who is buying a primary residence. So a 1031 exchange buyer is definitely very attractive for sellers. And Huddy can touch on that as he advises his clients when they're reviewing offers.
Yeah, actually, just got a new client that are moving into town. They're doing a 1031 and sold some commercial property in Nevada, but looking for a duplex, going to live on one side and rent out the other, all cash. So
that's why you didn't call me about these people.
No, you're absolutely right. And so, and the others is that a lot of first-time home buyers or anybody that really was getting a mortgage going up against all these people from the Bay Area with not only all cash, making offers way over asking. It was tough to see that. How do my clients compete with that? It's hard to try to keep the morale up with them and try to continue to tell them that there's something out there for everyone. Because I truly believe that, but just at time after time after time trying to tell them to keep their head up and hopefully that we'll get the next one. It got old quick, I'm sure.
Yeah, that's the big thing with new home buyers. Know your lane, stay in your lane. Don't push it. That's my big thing. I tell, don't get discouraged. It's easy to get discouraged in this market when you feel like you're the small fish. And you know what? Everyone started somewhere. Everyone had to buy their first home. And, you find sympathetic sellers out there too. Well, my parents bought, so they sold their house a while back and they were very adamant. They didn't want to sell to an investor. They wanted to sell to a family. They wanted to sell to someone that was going to make this a home. And that was something that was important to them. And there's a lot of sellers out there with the same values and they want to see it go to a family. Sometimes that's kind of the rub for the investors where you're just like, oh man, but just as a little slice of encouragement for those first time home buyers out there, people are getting into homes. People are getting into homes. They're buying them. They're taking that first step. So keep at it. Keep at it. You may not get the one picket fence. You may not get the one that you really want, but you know what? That's what sweat equity is all about. YouTube, HGTV,
100%.
Have fun.
Make it yours.
This is your place. Yeah.
It's such a good feeling. People don't realize there's no other feeling. You can't even really describe it, but it's just such this awesome feeling of accomplishment.
Big thing. Just, you always say buy the worst house in the best neighborhood. And that is, in the location, the 3 L's of real estate, those rules haven't gone away. The internet's come. Savvy online buyers have come. Investors, the new things that are happening in the market. Those rules hold true still. So you don't have to buy the nicest home that's all done up. Don't be intimidated by projects. Things can cost money and things can kind of get out of hand. Boy, don't be afraid. Don't be afraid to buy that ugly house in the nicest neighborhood with the good schools. Because let me tell you, that's going to pay off in equity when you go to sell down the road. And people are going to appreciate all the work that you put into that house.
That's awesome, Peter. Is there anything else that you wanted to cover that we missed that's super important?
No, you're great. I love this. I think the big thing for people is be encouraged. It's a tough market out there in California. On all the people across the nation who are listening to this podcast, know your local market. A family in Arizona, and they call me, like, know the neighborhood you want to live in. It's like, you guys got dreams. You know where you want to live. Do it. Go for it. Save. And just don't be afraid to take that first step. Talk to a professional. It doesn't cost you any money. It doesn't cost you any money to pick up the phone and call me and say, hey, Peter, I want to run some numbers. I want to see if I'm ready. And I might tell you you're not ready, but you can be in 6 months or you can be in a year. And let's get you on a plan.
You'll exactly.
The worst thing I want to hear is, hey, like without fail, 5:30 on a Friday, I'm packing up. I want to go see my kids. I get a phone call. It's like, hey, we found our dream house. We need to get pre-approved. They're accepting offers by 8:00 tonight. What? Can we get a pre-approval letter? Not in good faith. That's going to be tough. Let's start hashing it out. Let's figure this out now. But don't let your dream house come and go because you weren't pre-approved and ready to rock and roll. That's the biggest thing I can tell the buyers. It's easy. You got Redfin, Zillow. You got all of these online places where my wife still looks at homes every night. What do you think about this? What do you think about this? I'm like, babe, we're not buying a house right now. Stop. Yeah, that's great. That's a beautiful house. What do you think about this one? We could totally fix this one up. I'm like, yes, we could. We've got 3 kids under 5. And you want to be married. Like, it's crazy.
We're not buying that house.
The big thing is before you start shopping, talk to a realtor like Huddy. Talk to someone that you trust. Talk to someone like me who can run the numbers, who can get you set up so that you can start shopping for a home and never put the cart before the horse. Because that's when you hear about people with nightmare purchase scenarios. They're like, oh my God, it was so stressful buying a home. Like, it was just so crazy. It all happened so fast. And I got to ask questions like, well, were you ready? Did you take all the necessary steps to get ready to buy a home? Because I've got a lot of clients who had phenomenal purchase experiences. Not all of them. You don't bat 1,000. Sometimes things go sideways. Sometimes things get crazy. But yeah, the more you're prepared going into it, the better experience you're going to have. And so that's why you talk to professionals. You talk to a CPA. You talk to a mortgage guy. You talk to a good realtor that you trust. And you get your ducks in a row. and then you start shopping, and then you find that dream house. Because then when you do, and you can tell the person, pull the trigger, we're ready, make the offer. Guess what? You're not that person the next day saying, pending, we missed it. We missed
out.
Our kids aren't going to go to that school.
Yes.
That was my dream house. That's the one that we walk by every day. Don't be that person. Be ready, have a plan, and have the right people on your team helping you make that dream happen.
And not all brokers are the same.
Talk to someone. Love your realtor. Love your mortgage person. Love them.
Yeah. And if they can get along,
it makes a lot better, right?
Yeah, I think it makes all the difference. Hey, Peter, for the audio listeners, how are people going to get a hold of you? What's your email, contact, website? What do you got?
Yeah, I appreciate that. I work at Wholesale West Lending. We're a brokerage in Sacramento, California. And we're right near downtown. We're in the Arden area for all you local people who know where that's at. Highly ethical, small broker shop. Love serving people, especially the local community and all of California. That's where we're licensed right now. So you can catch me at peter@wholesalewest.net. And if you want to see how I look and how I live, you can catch my Instagram, Sacktown Loan Guy. I'm on there. And I'm not as handsome as I sound on this podcast. So sorry to disappoint everybody right now, but just fair warning.
Guess I should put that out there too. For all you just listening, I'm not a looker either, so don't get your hopes up. And for that, I apologize. No, Peter, it's been a great time. We had a blast. I always enjoy talking to you. You're so full of knowledge. You're an awesome guy. And I really appreciate you coming on here and supporting me and just sharing your knowledge. You provided a lot of value today, and I'm forever grateful. Thank you so much, Peter. Have a great night.